Okay, good morning or good afternoon, wherever you might be. Today is March 17th. I apologize, I got the date wrong, but I'm not going to redo this for the date. Today is Friday, March 17th. It's about 9:30 in the morning Pacific time. I am doing this video a little earlier than normal for a couple of reasons, a handful of meetings later on. We are doing a database upgrade tonight, Friday night. And so I've got a couple of meetings to make sure that goes smoothly. Market Smith, on a side note, you might experience intermittent issues, slowness, etc. This weekend. It won't be completely down, but we are doing an overhaul and an upgrade. So if you could bear with us for a handful of instances this weekend, if you use your charts on the weekend like I do, it'll be worth it with the upgrade in the database. Okay, and there is a message on the Marcus Smith homepage regarding this. My name is Scott St. Clair. I'll be your host. I'm the manager of the Premium Product Group here at Investors Business Daily. This is the disclaimer. Please take a moment to read this. I'm not licensed. We don't make buy, sell, hold recommendations. We're not analysts, etc. Our sweet spot is education, research. You should be doing this on your own. Take a moment, please. Okay, thank you. Sorry, my voice felt a little scratchy. So, all right. So market thoughts. I know last week somebody reached out to me. I forgot to do the industry groups. So hopefully I won't forget the industry groups this week. Stocks to watch. There's a lot going on in the market. The market is super dynamic. Allegedly, Confucius said, may you live in interesting times. These are sure interesting times as far as the stock market's concerned. And then the quote of the week. So a little test. I've got this historical chart of this stock. And I just want you to take the kind of bird's eye view. Imagine you stepped away from this chart and we're looking at it from really far away. You don't have any fundamentals. You don't know the backdrop of the market. You don't know the time frame as far as, when it was. But how would you interpret this chart? Think about it. Is it bullish? Is it bearish? Is it neutral? Would you want to be short this? Would you want to be long this? What if the market in the news was really bad? Would you want to be short this? What if the news was indifferent? Would you want to be long this? Maybe you'd wait for more strength to be long it. Maybe you'd be wait for more weakness to be short it. Let me ask you this. If you owned this, what would you do if the market was really weak? If you were short this, what would you do if the market was really strong? So you really want to try to isolate these stocks and these factors and try to ignore the noise. There's a famous story in reminiscences of a stock operator of a guy who lived in the mountains, and he would come down from the mountains every, I don't know, handful of months, or maybe even less often than that, and go to his brokerage firm and run a few trades, and then he'd go back to the mountains and do his thing, and then he'd come back and rinse and repeat, and made a bloody fortune doing that. So I'm just as guilty of it as anybody, but we all micromanage our trades, I think, in my experience, based on my feedback I get from people. We just micromanage these trades too much. So this is a chart of the NASDAQ yesterday. Well, actually, it's the QQQ. Okay, so let me resume the share. Now, this is the Qs updated. Let me backdate that chart. All right, and I have to admit, I took that screenshot yesterday about halfway through the day. because the market was bad. A lot of bad news. The bank stocks are acting awful, right? Totally awful. But the NASDAQ wasn't going down. And when I looked at that chart, I said, that looks very bullish to me. That chart looks bullish to me. Would I want to be short that? No way. Now, with the environment around us, unfortunately, we have that noise. Do I want to be long it? Well, that was the dilemma that I considered. And I have told you many times through the years, I've kind of gotten away and further away from the indexes giving me signals, whether to be long, short, sideways, whether to be 200% invested or 2% invested. Now, the QQQ is an index, right? It's the biggest NASDAQ stocks. But I was just seeing unusual strength in AMD, in Nvidia, in Amazon, Apple. These are all stocks that I just don't think are going anywhere, but there was unusual strength in them. So I bought the QQQ yesterday. So I was also short some names as well. I have a couple of bank stocks that I was short. Right or wrong, I was short Tesla, short an office property stock, and I'm short a solar stock. So I had exposure on the short side, not heavy, but enough. Now, I don't like to hedge. I'm not a big believer in hedging. In other words, oh, I'm short, let's go buy the NASDAQ. I will. The nice thing is it's highly unlikely I would lose a ton or make a ton. I'm probably going to, if the shorts work, I would probably lose in the NASDAQ. If the NASDAQ worked, I would probably lose in the shorts. But to me, the relative strength told me that I would, if I'm right on the NASDAQ, I'm going to make more there than I would lose in the shorts, and vice versa. The NASDAQ didn't want to go down. So my shorts were going down, but the NASDAQ wasn't. So I see that it is sort of a hedge, but I never put it on as a hedge. I put it on thinking, this is going up. I think I can make money in this from the long side, regardless of my other positions. That's how I think about all the positions. I very rarely, if ever, hedge. I think hedging is way overrated. Right from Bill's book, you could lose on both. And I've done it before. I've tried it, sold some calls in a stock I was long, rather than just sell the stock. Stock collapses, the calls go down a little bit. I just don't think it works. Now, if you can make it work, great, no power to you. I can only tell you from my experience, I have not ever made it work that from the standpoint of being worthwhile. It works a little bit, right? But not being worthwhile. So I always put a trade on with the idea that I think I can make money in this trade. So that's how I look at it. And then the NASDAQ, had a very powerful day yesterday. It's coming off these moving averages. You have this flat base. Let's reset to today. Now, it is down today, but not that bad relative to the bank stocks, relative to the S&P. So, the S&P is the weak sister. IWM, much worse than both of these indexes. It's NASDAQ 1, S&P 2, IWM 3. And so the moral of the story is try to isolate each trade as best you can. I know the M is important, but as best you can as its own unique setup. Mark Minervini talks a lot about it on Twitter. What would you do if there weren't any index? I'll go back to reminiscences of the stock operator, Jesse Livermore. They didn't have a Dow Jones Industrial Average, right? He would look around and kind of maybe mindfully make his own index based on what the leading stocks were doing. So I think that, for me anyways, has been a better way to trade. Now, maybe not for Joe Smith or Charles Harris or Risha Pierce or anybody else, but for me, that's the way I prefer to do it. So take that for what it's worth. Find your own way, I think is another moral of the story. So, all right, so let's pull up the indexes, just the index, and it's very rounded. You've got this kind of, I'm not a big head and shoulders bottom or head and shoulders top guy, but you could maybe draw some kind of conclusion from that. Could draw a trend line. Now it looked like it jumped above it yesterday, and now it's back below it. So maybe it could be a head fake, possibly. But I look around, I see a lot of weakness in certain areas and then unusual strength in others. And so maybe one has to give. The weakness in the banks will finally just overwhelm the leadership in the NASDAQ tech stocks, or vice versa. The bank stock crisis comes and goes, and now you've got a bit of a tailwind. I know I've mentioned IBD Live. One of the guys I like to follow on Twitter, every time we get into this, he always tweets, crisis equals opportunity. And that's absolutely 100% right. If you've ever looked at a long-term chart of the stock market and pinpointed all the crises along the way, it's exhausting how many things, long-term, I can just go through in my career, long-term capital, the tech bubble, the great financial crisis, the flash crash, COVID, on and on and on and on. So they create opportunities. So be ready for them. I don't know if that opportunity is today, tomorrow, or next week, or next month, but I know that it will create an opportunity. You want to be there. I was just looking at, I'm going to go off track a little bit here, but Costco, and we've got this series on Twitter with these historical charts. So we're marking up some historical charts. We'll do it once a day for a month on Twitter. And I've got some books with some historical fundamental data, so I can go back and say, okay, what did Costco look like technically at, in 1989 when it really started to get going, when it breaks out here. But what were the fundamentals like, right? Because that's important too. Charles Harris is on IBD Live this morning talking about, what's the story? Why Bill would always say, well, yeah, great, it's a good chart. Why should it go up, right? And so you need some type of a melting of both worlds, fundamentals and technicals. But here's the crash of 87 for Costco, right? It just got pummeled. I think it was down, I did the math, 14% that day after being down, it was down 8% the day before. And I'm having a hard time hovering my mouse over here, but take it for what it's, take my word for it. It's like 14%. So this creates the opportunity here, or here, or here, or here. So now this is a while. It took a long time. Maybe you could have snuck in there if you really knew Costco really well, or even here if you really knew it really well. But at this moment right here, the earnings and sales were on the table. Had 2 or 3 quarters of fantastic earnings and sales. And so that was, this is what I would think would be a better buy versus, this is a cheaper buy, a better price, but this is a much better buy at that point. So we're going to get some kind of opportunity. It's just, you got to be patient. Unfortunately, it's there, you can't make the market do what you want it to do. So I'm torn on the market. I do have some shorts. I do have a long position in the NASDAQ. I'm not over my skis by any means. All the position sizes are manageable, but they're meaningful. I do not like to take unmeaningful positions, because then if I'm right, then I'm going to try to add to it and press, and then I'm way out of position. And if I'm wrong, sometimes I've ignored smaller positions because they were small, and until the small position became bad because it was a small position and it went down a lot. And so I think, yeah, you have to have some skin in the game, a meaningful position, but not too meaningful that you can't handle it right. And there's a sweet spot for everybody. So like for me, it's around 10%, give or take. I happen to be short a couple of those bank stocks, and they were 8% positions.
Now it's sickening when, SBNY, for example, it went to zero over the weekend. And it's 8% position. I mean, if it was a long, I might have had a 20% position, but it wasn't going to double overnight being long. So you never have enough of the good ones, and you always have too much of the bad ones. That's the way trading is. So, okay, let's cut to the chase on the indexes. I think if the NASDAQ is holding up really well, I think the S&P is just okay. I think the Russell and the bank stocks look awful. There are some things that bother me, like the action in Schwab and Goldman Sachs. I would really like to see those stabilize. And I don't necessarily have to go up, but just stabilize, because if it spills from the banks to the brokers, then all bets are off. You're going to have another leg down for sure, if it does. And I really, and I'm worried about that, because I don't have an account at Schwab. I have an account at TD Ameritrade, which will become Schwab in a few months. So look, your money is protected by SIPC, et cetera, but who wants to get, tied up waiting for something to happen for months? I have an account at Fidelity as well. And maybe this is the height of the fear, as I considered transferring my accounts from TD Ameritrade to Fidelity, because Fidelity's private and they manage the most assets in the nation, maybe the world, I don't know, but the most 401k stuff. And so I would think that Fidelity would be fine. Let's hope, right? let's hope. Okay, so let's go back to the slideshow. So the bond market is the problem, right? And I'm not going to get into why SVB, Silicon Valley Bank, failed. Real simple, was a mismatch of duration. They're short-term deposits, and they're locked up in long-term bonds, and those long-term bonds are underwater. I think like 2/3 of the nation has a mortgage like at 5% or less, or maybe even 3% or less. I have a 15-year that I got a few years ago at 2.25. And now I just kept doing that because I just felt 2.25 was too low. And so I just kept trying to get low money, but somebody owns that mortgage and they will get paid. They will get their money back. But in a mark-to-market world, that mortgage is way underwater because rates are, foreign change now. So that's kind of what happened to the banks. And most of you probably understand that. But the bond market's trading like a biotech stock, and bank stocks are trading like a biotech stock. And you can see from this chart the outsized daily returns. Now look at what happened. There's Black Monday, which is the crash of '87. There's the Great Financial Crisis. There's 9/11, the terrorist event, and now we have the SVB contagion fears. Fast forward 6 months, 9 months, 12 months, 18 months. What do these all have in common? Right? Fantastic setups for the next leg up. It's like a forest fire. It clears the underbrush. It clears everything out. It gets rid of all the dead stuff and then allows the forest to grow. So, but that doesn't mean it has to start right now. So some of these events, I've Black Monday, I was a kid in high school, but in 9/11, I remember that extraordinarily well. I woke up in the morning and saw the tower on hit, and then I saw the futures on the TV, and then nothing was happening, and then the next tower got hit and the futures just plummeted, and I was like, whoa, so I lived that. Markets were closed for a few days, but we came out of that. And then the Great Financial Crisis, which took a lot longer, of course. So this is what we have to deal with, is the bond market. And then you got a Fed meeting next week, I think. This is
not a great screenshot, but I've talked about the Swiss National Bank before and in why I've been sanguine. I don't want to say negative because these are all great companies, but I'm not a big fan of the stocks, although Nvidia has proved me wrong, that's for sure. But Apple, Microsoft, Amazon, this is the balance sheet of the Swiss National Bank. Look at all these stocks that they own. So that's why I've always felt like they're very overowned and will have a hard time going up. But they've almost been, as crazy as it sounds, like a flight to safety in the last few days. Because they're big, they're liquid, and their balance sheets are clean. Apple has more cash than probably anybody. So, all right, this is from the book, The Model. I think it's called The Model. It has a long title, but anyways, I couldn't believe this this stat. So I rather than quote it, I took a picture of it so everybody can see that, the CGM Focus Fund managed by Ken Hebner, and Ken Hebner was the manager of the decade in 2010. So from 2000 to 2010, I can't remember which magazine named him the mutual fund manager of the decade. That's how good his performance was. Oh, there it is. By Morningstar, best performing U.S. diversified stock mutual fund, but he was the manager of the decade. So there's time-weighted returns. That's how much the fund went up, mathematically, 18% a year over the past 10 years. Yet Morningstar showed that when measured for capital-weighted returns, underlying investors actually lost 11% on average per year for the same period. So the best performing mutual fund, the average dollar won or lost is a loser of 11%. It's a discount equal to 29% over a decade. In other words, the average investor actually lost money by investing in the best performing fund. It seems like that's almost impossible, but if you think about how the money works, let's pretend he has $100,000 fund in 2000 and he goes up 100%. He turns 100 into 200. So he went up 100%. Well, now he's gets a flood of money and now he's got 10,200,000 and he goes down 5%. Well, 10 million of those dollars are down 5%. It's only the other smaller money that's actually still up. I know the math isn't correct, but bear with me, 95%, right? I know that's not the case, but you get the idea. So that's how this can happen. And why this happens is people chase performance. They run in and get excited at the highs, and they get very worried and protective at the lows. And it's natural. It's human nature. I don't know if I've ever told this story about the guy when I was a stockbroker in 2000. I was negative on the market. I thought the market had topped, and I got a new account from a referral, and the guy opened his account, and I did nothing in his account for months. And he called me and said, "What's going on? How come you're not doing anything?" I had discretion to make trades, and I told him I thought the market had topped, that the game was up, and he got really upset. He said, "I'll never forget when he said to me, 'Everyone is getting rich all around me.'" I'm not exaggerating. Those were his exact words. And this was March, April, May 2000, something like that. I can't remember exactly the time frame, but I'll never forget his words. "Everyone is getting rich all around me." And see, that puts a lot of pressure on you to get in there. Let's get going. And then the other way, if when things are falling, and I fall prey to it for sure. I'm pretty good at the other one. I think I'm better than average on the other one on the way up, but I'm just as guilty on the way down. I get protective and nervous and fearful at the lows, just like everyone does. Fear is a greater motivating factor than greed. All right. So the lesson here, if you want a lesson, is if you're going to buy mutual funds, and I've thought about this a lot and have tried this, and I couldn't do it. I thought when things are going good, I would take a little money out of my stock account, put it in a mutual fund, and just leave it there. Leave it there. Never do anything with it, and just slowly but surely accumulate kind of a side account with mutual funds. And I tried it, and I don't remember what time period it was, but I panicked, and the mutual funds were going down, and I sold them all. So I did exactly what I wasn't supposed to do. I was supposed to probably buy more, like Bill would talk about in his books, but I did exactly what I shouldn't have done, and that's why I don't do that. I just invest in stocks, ETFs, and now I invest in bonds because there's an actual return on them. Okay, so let's go to what happened to the slide for industry groups. Maybe that's why I didn't do it, is I've accidentally deleted the industry group slide. But all right, we're going to do these. We're going to do industry groups, and we're going to do stocks to watch back to back. That way I don't mess it up. Okay, industry groups. Metal products distributor, 3 stocks. And I'm going to turn my camera off so that we can see the screen better. All right. Semiconductor fabulous. This is the best group, semis. ALGM, Nvidia, Aehr, although it's super volatile. ACLS, these are the best stocks. Now, I'm not saying they're the best to own right now. A lot of them are out of position, but they sure have held up the best. Ooh, that's interesting. There's a bug there for sure. So building, residential, leisure gaming, semiconductor equipment. And you can see, like, this is the key. This is what I always look for. Where was the rank 3 months ago? 35. Last week was 39. It went from 39 to 6 in 1 week. Fabless 3 months ago was 116. Then last week was 9. Now it's 2. You really want to try to get on board when it's moving this way. I always think about the industry groups like, I'm going to date myself, but it's like a record, a Billboard top 40. So XYZ starts out by Taylor Swift. I'm just going to use her as an example, and now probably not for her because she's popular, but it opens at 50. It gets play. It goes to 30. People start to buy the albums. It goes to 8. People start to talk about it. It goes to 3, 2, 1, spends a handful of weeks at 1. Then it moves its way back down. And then it almost never comes back to 1, that song. Now, Taylor Swift can come out with another one and rinse and repeat. And so that's kind of how the groups work. They can come back, but that progression, right? You want to buy Taylor Swift's song, if you could, when it's 30 or 18 on its way to 1 versus when it's 1 on its way back to 18. So I don't see a lot of signal in the groups short of semis being the best group. I think that's the signal. Okay, so stocks to watch. What did I mention? I mentioned ALGM. This one bothers me a little bit. Gosh, I really messed this one up. I think Jim Ropel mentioned it when it was going up here. I think I talked about that. I actually bought it right on the 50-day and just, I don't know. I can't even explain how, when, or why I sold it. It's not like I made a bunch of money in it. So, but this stock is holding up really well. AEHR, I think Ed Carson mentioned today on IB Live, this would be if the end of the week, it'll build a base. Now, I don't know. It's not going to be much of a base, right? 37 down to 23, 37%. So it's going to be a big consolidation probably. But if you could stomach the ride, this is a good one. I've kind of lost interest because I can't stomach the ride. ACLS, great action right there. They tried to shake it out on the quote unquote bad news from Elon Musk and couldn't. So this is definitely a leader. And then as far as liquid and big, it's Nvidia. Nvidia is the obvious leader. Now, this is very, very pedestrian at best. That's being kind. So that's kind of why I haven't been
a big fan of Nvidia. The earnings and sales are not great, but the price action in the stock is telling a different story. So I know a lot of people have been talking about that. Let's talk a little bit about the banks, SBNY. So these types of things just don't come out of thin air. You know, stocks aren't 300 one day and 0 the next. If you study this, there's probably 47 sell signals. I mean, I was short the stock because of some people that I know, and I'm not a, you know, right or wrong, don't at me on it, please, but I'm not a fan of crypto. And this bank was, you know, huge in crypto. You had SI fail, another one I was short, although not, I was short here. I did not down here, unfortunately. But you already had precedent. Silvergate had failed, and then SIVB failed as well. I was short that, and I told that story about how I shorted it after it, you know, it blew up on the earnings. But again, if you look at the weekly chart, I just don't see any reason why you would be in that using our system. Not a single reason you would be in that stock if you followed the system correctly. You had more than enough sell signals. So, and look, and maybe one or two of you got stuck in this by accident. You lost your mind. I've done that before. You know, made a silly buy or sell. Shake it off, learn from it, and move on. Schwab, maybe that's easier said than done sitting in my seat. So, but I've been there. Believe me, I've had some really bad outsized losses in my life. And so I know that it's hard to get over, but the sooner you get over it, the sooner you can start to move on to getting that money back in something else correctly. So I talked about Schwab. I don't like the action in Schwab. Look, I don't need it to go back up. I just want it to stop going down. Goldman Sachs, oops. You know, this is not good action. So, you know, I think it's going to create a lid on the market for sure. There's for sure. But they don't need to go up because they're not leading stocks any longer. But they just have to kind of stop going down. And I think that could allow them the rest of the good stuff to go up. What else is out there that's there's FRC, which, you know, sounds like they, you know, they're going to get bought out, so to speak. And, you know, and believe me, it's not going to get bought out at a higher price. There's no way of that, I don't think. You know, it's probably be like a Lehman buyout, you know, where it's 20 one day and 8 the next. I don't know. Obviously, I don't know, but I would not be speculating in it even for half a second on a buyout on this to the upside. So there's some trepidation, obviously, in this area, and that's it's a problem for the market. There's just no bones about it. The shipping group has bifurcated pretty much. So TNK is holding up okay. TRMD is, well, today's action is not all that great, but it's still holding up relatively well considering. TK holding up relatively well, but TNP, I think, broke down. Yeah, TNP broke down. LPG broke down, I think. Yeah, and INSW, I think, was the other one that broke down. So oil has gotten hit really hard. Here's USL. So oil is, you know, this isn't exactly, but, you know, 70 to 59 in a handful of days. It's gonna be tough for those stocks to hold up. So that's probably all that I have for stocks to watch. Those are stocks that I'm watching is the shippers, but I'm in no hurry to get in them. I have you know, the only long I have is the QQQ, and I have some shorts that what but there I'm not in any hurry to go either way. Looking for some more clarity from the market. All right. Let's go to the quote of the week. and I can't remember where I got this. It was an interview or a book, but I have this quote sitting on my desk or taped to the wall in front of my desk, I should say. And the guy was talking about Ed Seykota. Ed Seykota was highlighted is not the right word. He was in Market Wizards, the original, and he has an amazing track record. I like his interviews. Very eclectic thinker, very different. Most of you, I'm sure, have read it, but if not, I highly recommend it. He, being Ed Seykota, said that when he looks at a market that everyone else thinks is exhausted its uptrend, that is often when he likes to get in. When I asked him how he made this determination, he said he puts the chart on the other side of the room, and if it looked like it was going up, then he would buy it. Of course, the trade was seen through the eyes of someone with deep insight into market behavior. So that I like this quote in relation to that QQQ chart that I gave you, right? If I were to put that chart across the room, that looks like a market that's going up. But here I am, short stuff, and banks are falling apart and all that, right? So, but when you just look at it from afar, it helps you to kind of, make a decision. So you reduce the noise. There was another guy in one of the Market Wizards books, I believe, that used to stand on his desk. He used to put his charts on, he used to put his charts on the floor and stand on his desk and look down on his charts, and just say, does that look like it's going up or down? Same kind of thing. So keeping it pretty simple as far as, making the best decision you can make, right? This is a game of imperfect information. I love listening to Charles Harris. He's on IBD Live. If you have that, I highly recommend you listen to it. He, sometimes I think I'm hearing things that I say. He says, he's really long this market. I think he just said he was on margin. So for whatever that's worth. But he started the year out pretty good. So he felt like he could take a little more risk, but he says, look, you have to take risks to make money in the market. Everybody wants it to be perfect. And if it's perfect, it's probably too late. The people that took the risk will sell to you when it's perfect because they have really good profits at that point. So you have to take risks. There will always be risk. You're taking calculated risks. When I short a bank stock, there's a risk. And I was short FRC and I was short SBNY on the weekend. And they were both 8% positions. And on the weekend, SBNY got taken over. So basically, effectively, the equity was a zero. So my account was up 8% in my mind. But FRC got an infusion or something. The news, at least on the surface, to me, and remember the market on Sunday night was up, the futures. So in my mind, I was like, okay, FRC is going to be up. How much is it going to be up? Let's say it's up 25%. That's not out of the realm of possibility, right? It has rallied like 50% off the low in certain situations. So I'm like, okay, so if it's up 25%, I have an 8% position. I'm going to be down, it's a quarter of 8, help me out here, right? It's 2. I'm going to be down 2% on the whole account. So I was like, all right, I can live with that. It's not fun to be down 25% on a single position, but I got one right and I got the other wrong. And one in the magnitude of the win would be greater than the loss, even if FRC did something totally ridiculous and was up like 50%. So you can make calculated guesses or bets or investments or whatever the word you want to use, but you have to think about the math in that regard. And I'm up pretty good already for the year. So let's say they both opened up 25% the next day. And I've got 2 8% positions. I'm going to be down 4% on the open. I'm not going to be a happy camper, but I'm I'm up plenty more on that. And so I'm just giving back some of my gains in that regard. So think about that when you take these risks along the way. And I kind of got off track of the Ed Seykota quote. I apologize on that. I think you're used to me getting off track, but I somehow I got on to Charles Harris and what he said about taking risks. And so I think it's important that you have to understand in the stock market, if you're waiting for it to be perfect, it's probably too late. So you don't have to be the first one in, but you don't want to be the last one in. There should be a little bit of uncertainty. It should feel a little comfortable. The best trades should feel a little uncomfortable. And in the end, FRC didn't open up at all. It opened down. So I made money both ways. And I'll tell you, it was an uncomfortable weekend for me because, it's here I am short, and there's talk of the government bailing the banks out, et cetera. But I had my plan. I knew on Friday, okay, this is the percentages. This is what could possibly happen. In a worst case scenario, could I live with that? And I felt like that had maybe a 15% probability of happening to me. But I felt like the other probability of disaster for these banks was not 85%. There's something in between, but had like a 40 or 50% probability. So that was a good risk reward setup for me. I'll take that trade all day long every time, because when you win, you'll win many more magnitudes of what you'd lose. Okay, thank you guys. Marcus Smith at investors.com, 800-424-9033. Again, I'll reiterate the database upgrade we're doing this weekend. Marcus Smith, we don't know for sure, right? But just in case, we want to be fully transparent. There could be some intermittent slowness, et cetera. We will have support this weekend. So in the easiest way is probably email. The phones will be on for a few hours on Saturday, just in case. But the easiest way always for any type of support is this email address, marcussmith@investors.com. And then I did mention the Twitter at Marcus Smith if you're interested in following along for those model book stocks. We'll do one a day for a month. All right. Have a great weekend, everybody. We will see you later.